Today, I want to explain what a bond is, how risky a bond can be, and why it's worthwhile to mix them with stocks. Hi, my name is Sean Kan, and I'm here to help you become smarter in the financial world. To understand what a bond is, we first need to clarify the terminology. Bonds are also often described as fixed interest securities. This means a security that pays a fixed interest rate at regular intervals. However, this isn't always accurate because there are also variable interest bonds, such as those linked to inflation, which don't pay a fixed interest rate. Bonds serve as a financing tool for governments or companies. These are called government bonds or corporate bonds, respectively. For example, government bonds in the US are called treasuries, like treasury bonds, and are used to finance the American state. In other places, like the United Kingdom, a government bond is called a gilt, and in Germany it is called a Bundesanleihe. It has different names in different countries. The same concept applies to companies. If a company wants to acquire another company, for instance, it needs capital. To obtain this capital, there are basically two options. Either the company issues new shares and thus takes on new shareholders, or it issues bonds and offers promissory notes on the capital market. The company receives money for these promissory notes, which it must repay at the end of the bond's term. During this term, the company, like with a traditional bank loan, must pay interest. Now, let's take a closer look at the issuance process, which is the process of issuing these promissory notes. Essentially, a bond always consists of three components: the face value, the coupon rate, and the maturity. The face value is the denomination with which the investor lends the money to the government or company. For instance, if the denomination is $100, the investor lends the government or company $100, which is repaid at the end of the bond's maturity. If the investor wants to invest more than $100, they must purchase multiple bonds of $100 each. Now let's move on to the second element, the coupon rate. The coupon rate is the interest at which the government or company borrows money and is then paid annually to the investor. Usually this is paid annually, but for US bonds, for example, it's paid quarterly, though only a quarter of the interest rate is paid each quarter. The term coupon originates from the time when small coupons were printed on the bond certificate, which had to be cut off annually to redeem the interest at the bank. Nowadays, everything is done automatically. In our example, let's assume the coupon rate is 3% per year, and the maturity is 5 years. This means we receive $3 per $100 face value each year for 5 years. At the end of the maturity, after 5 years, we also get the $100 face value back. So we receive $3 in interest plus the $100 face value repayment, meaning a total payout of $103 in the last year. The third element of a bond is its maturity. Generally, bond maturities range from 3 to 7 years, but they can be much longer. Some government bonds have maturities of over 30 years. However, this doesn't mean you have to wait 30 years for your money. Bonds, like stocks, are traded on the stock exchange. This means you can buy or sell bonds during their term on the exchange. Therefore, bonds, just like stocks, have a price. However, unlike stocks, this price is measured in percentage terms rather than in dollars. If a bond is trading at 100%, this means that you pay 100% of the face value to receive the full face value at maturity. So we pay $100 for our bond and receive $100 in face value repayment at the end. If the price drops to, say, 95%, we only have to pay $95 to get $100 of face value. This means we're buying the bond at a discount. As you can see, there are two ways to profit from a bond. First, through interest payments, and second, through potential price gains. Let's now address why some bonds have higher interest rates or yields than others. In this table, you can see the interest rates of listed government bonds. Actually, this table is the list of the yields of the government bonds and not the interest rate itself. For the purposes of this video, we'll treat both as one and the same, but I'll make a separate video explaining the difference between the two. Anyways, here you'll notice that German and Japanese government bonds pay significantly lower interest to their investors than, for example, Mexican bonds, which are now at around 10.44%. This means that investors earn less interest on German and Japanese government bonds, but these governments also have to make fewer interest payments. The key reason for this difference is the credit rating, which you've likely heard of before. The major credit rating agencies that assign these ratings are Standard & Poor's, Fitch, and Moody's. These agencies assess the likelihood that the country or company being rated will default and thus fail to fully repay its bonds. Since Mexico, for instance, suffers from poor long-term growth performance and has a lot of fiscal risk associated with their budget and ability to handle the debt of its government, Mexican bonds need to offer higher interest rates because their risk is deemed higher. Generally speaking, if a country struggles financially, there is a risk of defaulting, meaning that bond investors don't receive their face value back or would just receive part of their face value back, like what happened when Greece defaulted in 2015 and investors only got a part of their face value back. Investors expect compensation for taking on this higher risk, and so demand a higher interest rate. Therefore, countries like Mexico or Greece in the past must pay higher interest rates to finance themselves. This risk is reflected in the credit rating. Germany, for example, has the highest rating of AAA, while Greece has a BBB rating. Companies can't achieve a AAA rating as they are inherently riskier than governments. But if you want to make sure that you get AAA rated, according to 9 out of 10 financial advisors, liking the video and subscribing will definitely help. Now, while there is potential for speculation with bonds, they are generally a less risky form of investment than stocks. In the event of insolvency, bondholders are paid out first from the remaining assets, while shareholders come last. For this reason, bonds are excellent for risk reduction in portfolios, and many fund managers use them to make their funds less risky. That's it for the topic of bonds. If you have any questions or thoughts, post them in the comments. And if you enjoyed this video, then you want to check out this other video over here, which is about risk diversification, which I also have linked in the description below. Thanks so much for watching, have a great day, and I'll see you in the next video.